Let's talk about raising capital in the context of the limited liability corporation. Once you understand capital raising in the corporate context, in the context of the corporation, then it's easy to understand raising capital in the context of the LLC. It is basically the same concepts. We have equity financing and debt financing. Now, here, as we've discussed in earlier lectures, equity financing and equity interest in an LLC is called a membership interest. It is not called stock or shares. If in your LLC you want to call your equity interests stock or shares, you may, but under the law, an equity interest in an LLC is called a membership interest. All right. Just like the stock of a corporation, a membership interest in an LLC has control rights and economic rights. Let's talk about these in detail. Let's talk about the control rights of members in an LLC. If you have a membership interest in an LLC, you are called a member. You're not called a stockholder or a shareholder. You're called a member. What are your control rights? Well, the default rule in most jurisdictions is that if you are a member of an LLC, you have direct management rights and you also have voting rights. Let's look at your direct management rights. Each member of the LLC has the equal right to participate directly in the management of the LLC's business. So the default rule under LLCs is not centralized management. It is direct management by the owners. Now, you can create an LLC that is called a manager-managed LLC. We talked about this when we talked about formation of the LLC. You check a box or you put it in your articles of organization that you elect to be a manager-managed LLC, and in that case, then the managers have the right to run the business and affairs of the LLC, and the members do not. The management rights, equal management rights for every member is the default rule. You may change it in your operating agreement. What are the voting rights? Well, the voting rights in an LLC are per capita. Remember, the voting rights in a corporation was per share. Well, the default voting rights in an LLC is per capita regardless of your investment percentage. So let's say you invest $99,000 into the LLC and I invest $1,000 into the LLC. We each get a membership interest. If we do not provide otherwise, we have equal management rights and equal voting rights. You get one vote, I get one vote. This is a default rule. You may want to change it in your operating agreement. Now, you can see that little footnote down at the bottom. It depends on jurisdiction. In some jurisdictions, members of the LLC get voting rights in proportion to their capital contribution, in proportion to their investments. You just have to read your statute carefully to find out. All right, what are the economic rights of the members of an LLC? Well, let's talk about sharing profits. And it's not much different than what we discussed in the corporation. One important thing is that in the corporation, if you remember this, you share profits. Profits are allocated to shareholders based on their percentage of shareholding. So we gave this example when we talked about corporations. Imagine a corporation has 100,000 shares issued and outstanding, and I own 25,000 shares. Then I'm entitled to 25% of the profits. In an LLC, it's different. Profit sharing is per capita. So once again, if I have 25,000, if I have made 25% of the investment in the LLC has received $100,000 in investment from its members. One member invested $75,000, the other member invested $25,000. Profit sharing is equal. The parties will share equally in the profit unless the parties change it in their operating agreement. In their operating agreement, they can agree to share profits in whatever way they want. Now, once again, this depends on jurisdiction. This per capita rule depends on jurisdiction. In some jurisdictions, members of the LLC will share profits based on their capital contributions, in proportion to their capital contributions. So read your statute carefully. Let's talk about sharing losses. Remember, when we're talking about sharing losses in the LLC, we're talking about for accounting purposes only. The members will be protected with limited liability. So any losses, they will not be responsible to outside creditors. Sharing losses is how they will allocate losses among each other with respect to accounting. The default rule is that they will share losses equally without regard to their capital contributions. So you share losses equally, not in proportion to your capital contributions. Once again, this depends on the jurisdiction. In some jurisdictions, members in an LLC will share losses in proportion to their capital contributions. Let's talk about the capital accounts in the LLC. This concept is not unfamiliar. Remember when we talked about corporations, we talked about the company at formation, and we talked about the owner's equity account. The owner's equity account is effectively the capital account. So at formation, the equity holders of the company invest $10,000 into the company. So that means we will have, the company will have $10,000 in cash and assets, and owner's equity will be $10,000. The owner's equity account will show $10,000. So once again, I suggested that you think of the owner's equity account as your passbook, your savings passbook. And no one has passbooks anymore, right? Your savings account at your bank. You deposit $10,000 and your savings account will now have a balance of $10,000. And that's what we have here too. Let's say at the end of year one, our company made a $5,000 profit. If the company retains the $5,000 profit, then the owner's equity account will go up accordingly. It will go up $5,000. So if the company distributes the $5,000, then the owner's equity account will remain at $10,000. Let's look at this at more detail on how it will look in the LLC context. All right, so capital accounts in the LLC are specific owner's equity accounts for each of the members. So here, Bob invested $5,000 into the LLC. Mary invested $5,000 into the LLC. That is our LLC at formation. The LLC will have $10,000 in cash and assets, and Bob's owner's equity account, Bob's capital account, will be at $5,000. We'll show a balance of $5,000. Mary's owner's equity account will also show a balance of $5,000. So in the LLC, we don't have one owner's equity account. We have separate owner's equity account for each of the owners, and this is called the owner's capital account. So our same example, at the end of year one, our company makes $5,000 in profit. If the company retains the $5,000 profit, well, we're going to share it equally, right? So Bob's capital is going to go up by $2,500, which is half of the $5,000 profit, and Mary's capital account is going to go up by $2,500, which is half of the $5,000 profit. If the company instead distributes the $5,000 to Bob and Mary, then their capital accounts are not going to change from what was original. Bob's capital account is still going to be $5,000. Mary's capital account is still going to be $5,000. So if you understand owner's equity accounts, you understand capital accounts. It's just that capital accounts are separate owner's equity account for each of the members of the LLC. All right, let's take a look at how we would account for a loss. Remember, our company at formation looked like this. Bob's capital account was at $5,000. Mary's capital account was at $5,000. At the end of year one, the company loses $5,000, and that means each of Bob and Mary's capital accounts are going to be reduced by $2,500. So Bob's capital account will drop to $2,500. He is debited. He is allocated half of the $5,000 loss, and Mary's capital account will go down to $2,500. She is also allocated with half of the $5,000 loss.